Gold has long been regarded as a universal symbol of wealth and security, embodying a form of true money that retains value across civilizations, currencies, and ages. In fact, when we exchange dollars for goods, such as a pack of gum or groceries, we aren't merely trading pieces of paper but are, in essence, exchanging a proxy for gold or silver. This fundamental relationship is based on what is known as the monetary regression principle, a theory in Austrian economics that roots the value of current currency prices in past experiences. According to this principle, people understand and trust the value of today's prices because these prices connect to yesterday's values. Without this historical continuity, prices would lose meaning, and the entire economic structure would be jeopardized. Money's role, therefore, is not just transactional but structural, enabling the division of goods and services in a way that supports the entire economy. Without money, the division of labor would collapse, and the complex fabric of trade, specialization, and economic interdependence would unravel. The history of money, specifically the U.S. dollar, began not as a gold standard but as a silver standard. In the early days of the United States, silver coins were more widely circulated, and silver held significant value for the average person. However, as the gold standard took over, some argue that this shift primarily benefited the wealthy who already owned gold, effectively transferring wealth away from the middle class, who tended to hold silver. For our purposes, let's consider the dollar's modern identity as being rooted in a gold standard one where its perceived value is, at least symbolically, tied to the amount of gold it represents. But over time, this link has become symbolic rather than real. What began as a straightforward means of exchanging goods has transformed into a complex, often unstable financial system, where the dollar serves as a heavily inflated substitute for the gold it was once directly backed by. This fragile construct of fiat currency money that holds value only by government decree rather than intrinsic worth has shown its instability throughout history. For example, in 1933, during the Great Depression, the United States government revalued the dollar against gold, increasing the official gold price from $21 to $35 per ounce. This shift was essentially an acknowledgement that the dollar's previous valuation was unsustainable, forcing the government to intervene. Such adjustments expose the underlying instability in the dollar's perceived value. When governments alter the exchange rate between gold and fiat currency, it is often a response to economic pressures that threaten to destabilize the system. In a broader sense, these adjustments reflect the inherent vulnerability of any fiat currency, whose value can be swayed by policy decisions and market forces. The dollar, like other fiat currencies, lacks a fixed anchor, and when this perceived value wavers, it can trigger widespread financial instability. This volatility raises an intriguing question: what would gold be worth if everyone attempted to exchange their dollars for gold? This hypothetical, known as the monetary price of gold, is an exercise in imagining the true value of gold when its demand skyrockets as a safe haven for wealth. Current gold prices are largely set by futures markets, which reflect an industrial price tied to supply and demand for gold in manufacturing and technology. However, the monetary price of gold would likely be astronomically higher, potentially reaching $35,000 to $40,000 per ounce. This reflects a scenario in which global demand for gold as a monetary asset increases dramatically, with people everywhere trying to secure their wealth in gold rather than trusting increasingly unstable fiat currency. The difference between the industrial and monetary price highlights gold's dual role. It is both a commodity used in products and an asset trusted as a store of value. In times of economic stability, gold's industrial price generally dominates, allowing it to be traded like any other commodity. But in periods of uncertainty, Gold's monetary role takes precedence and its value skyrockets as people seek a reliable store of wealth. This distinction underscores why gold is viewed as a timeless asset. Its value persists beyond its industrial uses, embodying a form of wealth that remains stable even when other assets falter. A potential endgame scenario, as envisioned by Austrian economists like Ludwig von Mises, is what they term a crack-up boom, an event where hyperinflation accelerates to the point that fiat currency essentially becomes worthless. This is not merely inflation, where prices gradually rise, but hyperinflation, where the currency's value plummets as people lose all faith in it. In a crack-up boom, people abandon cash and other fiat currencies as stores of value, spending their money as quickly as possible to convert it into tangible goods before it loses further value. At this point, the distinction between central bank digital currencies, paper money, or other fiat alternatives becomes irrelevant. None retain value, leading people to seek hard assets like gold or silver. Historical examples such as Weimar Germany in the early 1920s or Zimbabwe in the early 2000s demonstrate the devastating effects of hyperinflation. In Weimar Germany, inflation spiraled to such an extent that a loaf of bread cost billions of marks, and people required wheelbarrows of cash for basic purchases. During this period, those who held physical gold or other tangible assets fared much better, as they could exchange their wealth for goods and services at far more favorable rates than those holding fiat currency. A mansion in Berlin, for instance, could be purchased for just a handful of gold coins, illustrating the tremendous purchasing power that gold retains in times of monetary collapse. If a crack-up boom were to occur on a global scale, as some predict, we might witness a scenario where gold holders could acquire vast amounts of real resources, as everything else would become devalued. The purchasing power of physical gold would skyrocket, allowing those who possess it to secure substantial assets, while fiat currency holders would struggle to preserve any value. This collapse in trust isn't just about paper money. It would extend to all forms of fiat substitutes, including digital currencies and even government-backed securities. When discussing this potential endgame, a crucial distinction arises between physical gold and paper gold investments, like exchange-traded funds, ETFs, that track gold prices but don't involve holding the metal itself. During a crisis, ETFs or other paper gold assets may become nearly worthless if people lose confidence in fiat currency and demand tangible assets. Even reputable ETFs, such as those offered by firms like Sprott, could face liquidity crises if all investors simultaneously demanded delivery of physical gold. In an endgame scenario, only physical gold or silver would likely retain value, as these assets cannot be devalued by government decree or market fluctuations in the same way that paper assets can. The same logic applies to other types of paper assets like stocks or bonds. If a currency collapse occurs, these investments would suffer as well, as their value is ultimately tied to the stability of the fiat system. However, mining stocks might retain some worth, as mining companies produce tangible commodities that hold intrinsic value. For example, gold mining companies could potentially pay dividends in gold or silver, allowing shareholders to earn real, asset-based returns even as fiat currencies decline. Nonetheless, even mining stocks are subject to market forces, and their value could be affected by broader economic instability. Thus, while some people may choose to invest in mining stocks as a hedge, the safest option in an endgame scenario remains physical gold or silver. If a hyperinflationary collapse occurs, society might revert to a system where physical gold or silver coins become the primary medium of exchange. This scenario, as described by Mises in his book The Theory of Money and Credit, would mark a temporary return to a physical currency system, as people abandon fiat money in favor of tangible assets. Initially, this transition could be chaotic, with people demanding gold or silver for goods and services until a more stable financial system can be reestablished. Though this situation may only be temporary, it illustrates the fundamental role that physical assets play in establishing trust and stability in a monetary system. Over time, as economic conditions stabilize, substitutes for physical gold may reemerge, and people may once again trust banks or other institutions to store their wealth. In this new system, however, there may be competing currencies, each backed by tangible assets, allowing people to choose the most trustworthy options. Unlike today's monopoly on currency, where the government controls the money supply, a free market in money could emerge, with competing currencies driving out dishonest or unstable options. In light of these possibilities, those concerned about the future value of their wealth might consider buying physical gold or silver, not as a speculative investment, but as a form of insurance against monetary collapse. Unlike fiat currency, which can lose value rapidly, physical gold and silver retain worth because they are tangible, limited resources that cannot be artificially created or manipulated. Some may argue that holding ETFs or other paper assets can provide exposure to gold's value, but these investments depend on the stability of the financial system. In an endgame scenario, where fiat currency loses all credibility, only physical assets are likely to hold true value. For those investing in gold mining stocks, ETFs might serve as a way to speculate on gold prices, but they should not be relied upon as a store of value in a collapse. These investments remain part of the same financial system, susceptible to market fluctuations and currency instability. Instead, physical gold and silver offer a timeless form of wealth that transcends the limitations of fiat currency, providing a safeguard against the uncertainties of an unpredictable economic landscape. In conclusion, gold and silver stand as symbols of true money, assets that retain value in a world where fiat currencies are subject to inflation, devaluation, and collapse. While the dollar and other fiat currencies have temporarily replaced gold as the primary medium of exchange, the intrinsic value of precious metals persists, ready to serve as a store of wealth in times of crisis. Whether the endgame comes in the form of hyperinflation or a more gradual erosion of fiat currency value, physical gold and silver will continue to represent true wealth, trusted for their ability to preserve value across generations.